which means rental income or dividend income or interest income, some sort of regular profit that you generate from that $100,000 investment. So in this case, our taxpayer has a $5,000 tax deduction because of their RRSP contribution and a further $5,000 tax deduction because of the $5,000 in interest that they paid in order to sustain that loan. Now this person really did spend $10,000. They put $5,000, that is, they wrote a check for $5,000 that went into their RRSP, and they wrote a check for $5,000 to pay the interest owing on that $100,000 loan. They really spent $10,000. But CRA says, hey, we're going to give you a little bit of a break here. We want to encourage those behaviors. We want to encourage you to contribute to your RRSP, and we want to contribute you to borrow to invest, because when you invest that $100,000, that money is going to work now. That's going to grow our economy. To encourage that, we're going to give you some tax incentive. Specifically, we'll take those two $5,000 deductions, and we'll allow you then to reduce your income, so that now this person's not paying not paying tax on $70,000 of income. Instead, they will pay tax on $60,000 of income. This is what we refer to as their net income, which I know is a term that gets thrown around a little bit. It has several different meanings, but for our purposes here and in CRA's eyes, net income refers to total income less deductions. So $60,000 of net income. And then, once we arrive at that $60,000 of net income, we're going to figure out how much tax is payable. So at this point, we would apply what are called the marginal tax rates. Now, the marginal tax rates apply to all Canadians except those in Quebec. Quebec uses a completely separate system of taxes that you don't have to know anything about for the purpose of this course. But in the rest of the country, in the other 9 provinces and 3 territories, we have a set of federal marginal tax rates. So, at the federal level, what happens if you earn between $0 and $40,000, that K is thousands of dollars. If you earn between $0 and $40,000, then you're going to be taxed at a federal marginal tax rate of 15%, which is relatively low. The federal government takes 15% of whatever you earn. So what happens if you make more than $40,000? If you make between about $40,000 and about $80,000, and of course these figures are rounded off. This is not exactly what the figures are, but relatively close. If you make between about $40,000 and about $80,000, then you're going to be taxed at 22%. Well, hang on a second. That doesn't really seem fair, does it? What if I'm making $38,000 one year and $42,000 the next? I have this giant jump in my tax rates. Well, Revenue Canada has thought of that. And what they're going to do, to be fair, is they're only taxing you if you make $42,000. Only $2,000 of that is taxed at 22%. The first $40,000 that you earn will always be taxed at 15%. And the same is true for every Canadian. It doesn't matter how much money you make, everybody, no matter how wealthy, pays tax at a rate of 15% on their first $40,000 of income. This person then only pays, if you have somebody making the $42,000 that I alluded to a minute ago, that person only pays 22% tax on their top $2,000 of income. So you're not really penalized for making more money. In Canada, we have what's called a progressive tax system. That is, you pay more tax as you earn more income, but you're not penalized for making more income either. That's an important concept. Our progressive tax system continues. If you make between about $80,000 and about $130,000, then you're going to be taxed at 26%. And if you make more than $130,000, then you're going to be taxed at the highest federal marginal tax rate, which is 29%. The provinces also have their own set of tax rates. It's different in every province. Every province has its own set of tax rates. In British Columbia, there are 5 different marginal tax rates, which don't really coincide nicely with the federal tax rates. Ontario has 3 marginal tax rates, which don't coincide nicely. Manitoba has 3 marginal tax rates, which don't match up with the federal rates. Saskatchewan has 3 marginal tax rates, which don't coincide with the federal rates. Some provinces like Ontario charge an extra tax, a surtax, which is a tax based on the amount of tax that you have to pay. Alberta is an exception to the rule here. Alberta is the only jurisdiction in Canada which uses a rate other than progressive. Alberta uses a flat tax, which is 10% across the board. Every taxpayer in Alberta pays tax at a rate of 10% on whatever income they earn. So what would happen if you were an Alberta taxpayer? You would pay 25% on the first $40,000, 32% on the next $40,000, 36% on the next $50,000, and then 39% on everything over and above. If you are doing an exam question, you're generally going to be provided with a tax rate. There's no need to memorize these. If the exam question says something like, John is taxed at a rate of 30%, just use 30% throughout the question. Don't let your understanding of the tax rates confuse you. If you're doing an exam question and you need a tax rate and there's not one given, generally you'll be dealing with very large amounts of money, and what's happening in that case is the exam writer is assuming a 50% tax rate. Yeah, 50%, that's right. That used to be quite a common tax rate. It used to be that in most provinces, the highest income earners would pay tax at a rate of 50%. That's still the case almost in some jurisdictions, but we're starting to get away from that. There's actually nobody in Canada who would pay tax at a rate of 50% today, but some people come very close to that. So these are our federal tax rates. We're going to just stick with federal tax here. I'm not going to add provincial tax in because it somewhat confuses the situation, especially when we talk about taxation of investment income in a few minutes.